Hello everyone, hope you all are doing well. Welcome to Diplomat's Desk. I am your host Meet Shah. What happens when the price of your favorite smartphones drops by 10%? Do people rush to buy it or demand barely moves? That simple question leads to one of the most powerful ideas in economics, which is elasticity of demand. And today we will decode elasticity using fresh data from 2025 economy, and we will analyze it the way a data scientist would, with numbers, graphs and insights you can use. In plain terms, elasticity measures responsiveness. Economists define price elasticity of demand as the percentage of change in quantity demanded divided by the percentage change in price. If the value is greater than 1, demand is elastic. Consumer responds strongly. If the less than 1, then demand is inelastic. They barely react. We also have income elasticity and cross elasticity. What is income elasticity? Demand changes when income rises, and cross elasticity is how demand for one product reacts when another's price changes. Think of elasticity as the sensitivity meter of an economy. Elasticity is not just textbook theory, it's the heartbeat of pricing strategy and tax policy. For businesses, understanding elasticity helps decide whether to raise or cut prices. If demand is elastic, a small discount can skyrocket the sales. If it's inelastic, firms can raise prices without losing much revenue. For policymakers, it's key to designing tax and subsidies. India taxes fuel heavily because petrol and diesel demands are relatively inelastic. We still drive, ship, and fly regardless of modest price hikes. So let's put this into data. According to the Reuters December 2024, rural consumer spending on non-food items in India jumped to 9.55%, while urban spending rose 8.31%. At the same time, the National Statistics Office estimated rural income grew about 8%. So let's compute. Income elasticity equals to 9.55 divided by 8, approximately equals to 1.19. That's greater than 1, means rural discretionary demand is income elastic. As people earn more, they don't just buy more food, they upgrade to smartphones, branded clothes, or household electronics. From a data science perspective, we visualize this as a scatter plot of income growth versus spending growth. The regression slope above 1 confirms a strong positive elasticity, signaling rise aspirations in Bharat's emerging middle class. Now contrast that with India's fuel demand. In January 2025, diesel consumption fell 4% month on month, even though prices rose slightly but remained up 4.3% year on year. That pattern tells us fuel demand is price inelastic in short run. If we approximated the elasticity of fuel demand, price rise approximately 3%, quantity drops approximately 4%, which means elasticity is 4 divided by 3 equals to approximately 1.33 in magnitude, but because this change is temporary and demand quickly rebounds, the effective short-term elasticity is closer to 0.5 and 0.8 after adjusting for seasonality. In data terms, the R squared of price explaining quantity would be low, meaning other factors like transport demand, infrastructure, and substitutes dominate. So summarizing our mini analysis, rural non-food demand income elastic is greater than 1, fuel demand price inelastic, which is less than 1. Two different behaviors, two very different policy implications. Now, what does this tell us? For businesses, if you sell to rural India, target aspirational categories. A 1% income rise can generate more than 1% demand growth. Data says it's happening already. For government, taxing inelastic goods like fuel or cigarettes can raise steady revenue without crashing demand, but must balance inflationary impact. For investors, high income elastic sectors like consumer durables, e-commerce, and travel could outperform, while inelastic sectors like utilities stays defensive. So here's the bottom line. Elasticity of demand is not just a math, it's a human behavior quantified. In India today, the data shows two stories. Elastic India, where rising incomes amplify demands for lifestyle goods, and inelastic India, where essential like fuel remains stable despite the price swings. Next time you shop, ask yourself, if the price doubled, would I still buy it? That's elasticity in action. If you enjoyed this blend of economics and data science, hit like, subscribe, and comment below which Indian product do you think has the most elastic demand right now. Let's make the economics data driven and fun. Thanks for watching.